And so just remember that. The last time around, it was the unsexy markets. It was the ones that no one really paid attention to, the ones with low appreciation that did the best in the crash. And it's likely to be the same story in 2021 and 2022 when the bubble bursts again. How's it going, everyone? This is Nick. I'm extremely excited about this episode today because we're going to take a look at the 5 housing markets in America that are going to survive the impending housing crash. That's right. So if you've watched my videos, you know I think that we're in a massive real estate bubble in America right now that's set to pop in the next year. And I know a lot of you out there, you're prospective home buyers, you're prospective real estate investors. I talk to a lot of you in the comments, a lot of you email me, and the question is usually the same. Is it safe to buy right now? You know, if I invest my hard-earned money in real estate right now, am I putting it at risk? And I would say more generally, yes, you are. You would be investing or buying at the point where real estate is the highest price it's ever been compared to things like inflation, wages, and broader economic growth. Real estate has never been more expensive, and that's a sign that it's probably going to become cheaper very soon. However, I know some of you need to move, you need to buy a home, you need to pick a new place to live, you want to buy an investment property, even in a bubble, because you have the cash and you want to put it to work. So I get that. So what I'm going to do for you in this video is I'm going to show you here in mid-2021, when the real estate market has never been more frenzied, never been more crazy, is in a massive bubble, what are the 5 cities that you can still buy in this crazy market and feel secure and comfortable? Cities that when there is a housing crash are going to withstand it. And maybe values go down by a little bit, but they're not going to go down by a lot, and you're going to feel safe and secure in your investment. And the way that we're going to do that today is we're going to go back in history, and we're going to look at the 2007 housing crash, and we're going to analyze which markets got affected the most. Because obviously that was the biggest housing crash in U.S. history, 25% price decline across the board. But what a lot of people don't know is that there was significant variation in how different markets were affected. Vegas, Phoenix, a lot of those places got destroyed, 50, 60% value declines. A lot of people lost everything. But there was a segment of cities which actually grew home prices during the last housing crash, which was the worst one in U.S. history. There was like 5 cities which actually grew home prices, and there was another 10 to 20 which only experienced like 5% declines or less. And so in this video, we're going to analyze what were the characteristics of those cities that weathered the storm last time around, and how we can use that information to find the cities that are going to weather the storm this time around, and the ones that are going to survive the impending housing crash. Also, you guys are going to want to stick around for the end of the video because we're actually going to take a look at some properties that are for sale in these cities right now, so I can show you just how much value is being offered in some of these markets. We're going to take a look at some specific properties, so you're not going to want to miss that. Stay tuned to the end of the video. All right, guys, without further ado, let's get into it. So I want you guys to take a look at this map. This is a map of all 500 plus metro areas in America. And the way I want you guys to think about this is that there are 500 housing markets, 500 different housing markets in America. People love to talk about the U.S. housing market more generally, as in like the national housing market. But in reality, there's like different markets in different parts of the country. And really, each metro area has its own dynamics going on in terms of prices, affordability, wage growth, job growth that you need to monitor on your own. So what we're going to do is by the end of this video, we're going to narrow down this map of 500 metro areas to 5. There's going to be 5 left on this map at the end of the video, and these are going to be the ones that if you're an investor or home buyer in 2021 and you still want to put your money in the market, these are going to be the 5 metros that are going to offer you the best value and security at this point in time. And the way that we need to get started here is by looking at the last housing crash, 2007. Because the characteristics of this crash and understanding which markets got hit the hardest and which ones actually weathered the storm, that's going to give us a lot of information to understand which cities and markets today in 2021 are going to weather the storm. So what a lot of people don't realize about the last housing crash is that it wasn't very uniform across the country. There was really a segment of cities, maybe like 20 to 30, that got hit really hard. There was maybe another let's just say 150 to 200 that, were they got hit hard, but close to the average of around, 25% decline. But then there was a segment of cities that actually grew home prices. amazingly grew home prices in the midst of the worst housing crash ever, right? And understanding why these cities grew their home price in the face of this crash is going to give us a lot of information actually about which ones in 2021 that you're going to want to target. So what we're looking at on this graph, guys, are the home price changes in the 50 largest cities in America from 2007 to 2012. And here's the color coding. The bars in yellow that are kind of further extending down this graph, these are the markets that lost the most value. So you can see, for instance, Las Vegas, from 2007 prices went from 357 to 130,000. That was a 63% decline. Vegas got hit harder than any other large city in the US. And then all these other markets here, the Orlandos, Phoenixes, Riversides, Miamis, Tampas, Sacramentos of the world, these other markets also got hit hard with like 50% declines. But then if we zoom over to the other side of the graph, we can see, oh wow, we actually have three big cities that grew home prices in the last crash. Pittsburgh grew prices by 2.7%, Buffalo by 2.4%, and Oklahoma City, just by a little bit, it grew prices. And so you can see, wow, huge variation around this average line where 25% was the average downturn. And it's important to start to ask this question, what are the common characteristics of these cities on either end of the graph? Guys, I put a lot of effort into these videos. I love sharing this data with you. In return, all I ask is just please hit that like button. When you hit the like button, it tells YouTube it's a good video, gets me some more exposure. I would just really appreciate if you could do that. Additionally, make sure to comment. I want to hear what your thoughts are. What are your experiences in the real estate market right now? When you guys comment, it makes me more informed. It makes these videos better. So please comment. I make sure to respond to pretty much everyone. And if you haven't already, subscribe. We have 2 to 3 new videos a week covering different real estate markets around the US. Make sure to subscribe. All right, let's get back to the video. And if we go back to the yellow bars, we can see it was a lot of warmer climate, southwest, southeast cities that got hit hard last time. We can also see, there were some mainstay cities such as Los Angeles, San Diego, San Francisco also got hit hard in the last crash. So it was really a mixture of these like growth markets in the southwest and southeast, as well as some expensive markets in California, which got hit really hard. But if we go over here, Pittsburgh and Buffalo, the two markets that gained, these are some of the most let's just say, runt of the litter markets that no one really pays attention to. Pittsburgh was a steel town. Its employment and population has been stagnant over the last 20 years. Buffalo, much the same. A lot of industry has left these cities over the last 2 to 3 decades, but yet they still grew value. And then we see some other cities like Austin, weathered the storm pretty well last time in the last crash. Rochester, New York, San Antonio, Houston, Louisville, Dallas, Indianapolis. So the cities that did well last time, it was a mixture of kind of Rust Belt cities like Pittsburgh, Buffalo, Louisville, Indianapolis, and then it was Texas. It was kind of Texas cities like Austin, San Antonio, Houston, Dallas. They really didn't get hit that hard in the last crash. And so I think the fundamental question is why? Right? What was the driving force there? Why were Midwest Rust Belt towns like Pittsburgh and Buffalo, and then growth markets in Texas like Austin and San Antonio, why did they hold their value? What was the similarity that they shared? Right? And then what was the similarity that markets like Las Vegas, San Francisco, and San Diego shared, that they all lost value so much? And when you look at the data, there's really one huge factor which explains the differences in these price declines in these markets in the last crash. That factor is price appreciation. That is price appreciation before the crash. Looking at how much prices went up from, say, 2001 to 2007 was very then indicative of how much prices went down from 2007 to 2012. Basically, the more that prices went up during the middle of the bubble, right, the more that prices went up in the mid-2000s, the more they crashed when the bubble burst. And this relationship is extremely strong and extremely robust, and really is going to inform a lot of our decision making about which markets to focus on today. And so take a look at what I mean, guys, on this graph. So over here on the x-axis, we're looking at the value growth in real estate prices from 2001 to 2007. And then we're looking at what was largely the value decline here on the y-axis from 2007 to 2012. And this, of course, is data that comes from Zillow. They're tremendous data resources, which you can actually download for yourself. I'll have a link in the description. They make all this publicly available, which is great. But so we have, again, the price increase from 01 to 07, and then the price decline from 07 to 2012. And you can see right off the bat, there's an extremely strong relationship between the two, right? We have these yellow dots down to the bottom right, the Phoenixes, the Vegases, the Orlandos, the San Diegos, the Miamis of the world, where we can see they increase prices like 100%. Prices basically doubled in these markets from 01 to 07, and then they collapse by 40 to 50% thereafter. Then we have these markets in blue in the top left, right? You remember we just talked about Pittsburgh, Buffalo, Oklahoma City, Austin. What was the trait that they all shared? The trait that they shared was that prices never appreciated much to begin with, right? So in Austin, for instance, between 01 and 07, prices only appreciated by 12%. Really low growth. I mean, that was less than inflation in that time frame in Austin. And then prices only declined by 4% in the subsequent crash. Wichita, Kansas is another market where prices only increased by 21% prior to the crash, declined by 1.5% thereafter. Indianapolis, Denver, Rochester, these are markets where the same exact thing happened. So in the top left of this graph, I want you to think, these are markets that weathered the last crash well. Why did they do it? Because their existing appreciation rates before the crash were low. Why did these markets in yellow get hit so hard? Well, quite simply, it's because their appreciation rates prior to the crash were high. And I just want to point you to this dotted line, which measures the trend between these two. Not to get too technical, but this is an R-squared of 0.65, which means that basically the variation in appreciation rates before the crash explains basically 2/3 of the decline after the crash. So there's a massively strong relationship here. So the reality is in 2021, and it has been for the last 20 years, I talked about this in the video on inflation I did a couple weeks ago. The reality in real estate now is that it is a volatile asset class. Prices will go up, they'll go down, they'll go up, they'll go down. And a lot of people are like slow to acknowledge this. People still seem to think that real estate is a secure asset. And that's why a lot of people try to come up with excuses, even in 2021, only 10 to 15 years after the last crash. They're trying to come up with excuses for why we're not going to see similar price declines this time around. And my response to that is it's garbage. Very clearly, the analysis is clear. In the last crash, it was price appreciation, which then determined the declines. It was the price appreciation in the markets that then said how much the decline was after the fact. And if you had owned in the Austins, in the Buffaloes and Rochesters of the world in 07, the markets that were not sexy to own in, the markets that no one was paying attention to back then in 07 from a real estate perspective, you would have done so much better than investing in the markets that were the hot markets, the markets that were in the headlines. And so just remember that. The last time around, it was the unsexy markets. It was the ones that no one really paid attention to, the ones with low appreciation, that did the best in the crash. And it's likely to be the same story in 2021 and 2022 when the bubble bursts again. Now, I just want to quickly address something, and that's the subprime mortgage crisis that went along with the last housing crash. I see a lot of people say that we're not going to have a housing crash this time around because there's no real subprime crisis, and that the quality of the loans being given to people are much better today than they were back then. So they say, oh, we won't have a crash. Well, while it's true that lending standards have gotten a lot better, it's not true that subprime caused the last crash. That's false. What caused the last crash was appreciation and speculation, bidding prices up above what the local wages could support. And we're going to touch more upon that point in a second about wages. But it was the price appreciation which caused the price depreciation. If you actually look at market by market, the percentage of loans that were subprime in different cities had a very weak relationship with the subsequent decline in prices. You have places like San Francisco, which had almost no subprime loans, but still saw a 35% decline. So subprime, I want you guys to remember this, it was not the cause of the last crash. It simply made it worse in certain markets, but it was not the cause of the last crash. The cause was rampant price appreciation above wage growth. And that second point here is key, wage growth. Because after all, it's local incomes and wages which are going to determine the long-term outcome for real estate markets. If prices go up much faster than wages, which is what has been happening in America for the last 5 to 10 years in most markets, prices are greatly exceeding wages. At some point, and this is happening today, and I know you guys feel this, you're pricing out regular people, couples, families from being able to afford a home. And that's a problem for the stability of the real estate market, right? Because if regular people can't afford a home, I mean, that's the fundamental demand for homes, is regular people living in homes. So all of a sudden, the demand has to get pushed to investors and speculators. And we're seeing a lot of that. A lot of big companies, a lot of small mom and pops coming in and buying up properties for investment purposes. The unfortunate thing is, when prices peak and then start to go down, those investors who spurred demand are now going to spur selling and supply, right? Because if you're a profit maximizer investor, you're going to sell if you sense the market's going down. That's going to flood the market with inventory, and it's going to push prices down further. And so I really want you guys to understand this. The more the prices get up above wages, the more stressed that local households are, the more that investors and speculators need to come in and support the demand. The problem is those investors and speculators aren't in it for the long haul. They're going to sell at some point. And, I want you guys to see what I'm talking about here on this graph, where we're looking at the comparison of the growth in wages in hourly earnings from 2015 to 2021. And then we're looking at the home price growth over the same period in different markets across the U.S. The wage growth is data from the BLS. I'll have a link to it in the description. And once again, home price growth is from Zillow. And the way I want you guys to think about this graph is if your city is yellow, and if your city is yellow and above this dotted line, that means that prices are going up much faster than wages. And that's a destabilizing force for the local real estate market. This was the same exact type of force that caused a crash in certain markets in the last housing downturn. Now, if you're a blue dot, if you're below the line, if you're in Oklahoma City, if you're a Baltimore, if you're a Peoria, Illinois, if you're in Albany, if you're a Buffalo, if you're in Omaha, if you're a Greenville, South Carolina, it's the opposite. Your wage growth has actually kept pace with home price growth. So for instance, in Albany, over the last 6 years, you could see wage growth was 26%, price growth was 28%. They're basically 1-to-1. So local households in Albany, the wages are keeping up with home prices. Similar situation in Oklahoma City. Wage growth was 20%, price growth was 26%. In the ninth inning of a real estate expansion, it's better to be in these blue cities because they have better, firmer income and wage fundamentals that are going to support the market during a downturn. Compare that to a place like Boise. In Boise, wage growth has been 20% over the last 6 years, like the same as Baltimore, basically. But price growth has been 112%. So literally, prices have gone up by almost 6 times more than wages. And that's just not a sustainable situation. At some point, those prices are going to want to come down to what the wage earners in the local economy can afford. Similar situation in Salt Lake, which is 4.6x, Austin, which is 5x, Seattle, which is 7x, Columbus, Ohio, Durham, North Carolina, and a lot of these other yellow dots is prices are increasing much faster than wages. And basically, a lot of the support for the demand in these markets in yellow is coming from unsustainable sources right now. It's coming from a lot of investors, cash buyers who, all right, great, you can prop up the market in the short term, but when the market turns, all of those people are going to be out the door, and who's going to be left is going to be the local households to support it. So as a home buyer and real estate investor in 2021, investing into a bubble, you want to be in the markets with lower appreciation and higher wage growth. Low appreciation, high wage growth means that you have a much better fundamental foundation for your local real estate market. So when the bubble does pop and that maybe prices do start going down and inventory starts going up, if you're in a market like a Baltimore or an Albany, the local renters will still be able to afford the homes. And that's very key. The local renters will still be able to afford the homes, and they'll step in and support the market. In a place like Boise or Austin, the local renters are totally priced out right now. So they're going to wait for prices to fall before they can afford a home, right? And so that's the key determination here, the relationship between prices and wages. Now, in addition, in a market, if you're investing in 2021 and you want security, you want to feel safe, not only do you want low appreciation leading up to now and high wage growth, you probably want to invest in a market that is of a certain size, just population-wise. You don't want to invest in a place that has like 50,000 people because there's a lot of insecurity, especially economic insecurity in those markets. It's also very easy to add new supply. So you want to invest at least in a population that has 500,000 or so, like a certain baseline of size is a very important thing. And then the other thing is you probably don't want to invest in a place that has economic contraction, right? And the reality is we're going to be excluding a lot of the high growth markets from our analysis here with our price appreciation cap. But at the same time, we don't want like huge economic declines. Obviously, that's not good for real estate markets. So the other thing you want is at least a certain degree of economic stability, right? You don't want to see like in, for instance, Peoria, Illinois, which is a cheap market, but it's lost 10% of its jobs over the last 5 years. You probably don't want to be in a market like that. All right, so guys, are you ready for the big reveal of the markets that are going to survive the next housing crash? Let's get back into that map. Wow. Wow, look at this, guys. We went from 500 to, we actually have about like 13 or 14 left on here. And these are really the only handful of markets that meet our investment criteria that we just discussed. Really, everything else is pretty much off the table. If we're saying lower appreciation, higher wage growth, a certain population size, and not too many job losses, these are really the markets that fit the bill. And you can see right away, they're not the sexiest markets. We're talking places like Albany, places like Buffalo, Milwaukee, Omaha, Oklahoma City, markets like that, which really don't, get anyone too excited, but those are actually the type of places that you want to be investing in 2021 at the peak of a bubble, because they're going to withstand the crash the best. You can see that we also have some markets here in the Southeast like Winston-Salem, Greenville, South Carolina, Huntsville, Alabama, Birmingham, Alabama. These are markets that also fit the criteria we described. However, I suspect that if you go into a market like Greenville or Huntsville right now, you're going to have some difficulty finding a property that makes sense from a value perspective. Zillow says that prices have only appreciated in Huntsville by 40% over the last 5 years. I'm a little skeptical when I look at the stuff that's on the market right now. So don't ignore these Southeast markets. Surely check them out. But I think you're going to just have a harder time, especially as an investor, finding a property that's going to give you yield and that you're not going to overpay too much for in these Southeast markets. It's really the ones that we're going to be focusing on are going to be Albany, Buffalo, Milwaukee, Omaha, and Oklahoma City. These are the 5 markets that I think are the best places to buy right now and the ones that are going to survive the crash, the impending crash. And why is that? Once again, because prices and wages in these markets are much more linked to each other. Local households, local renters can still afford the prices. Even with the run-up that we've seen over the last 5 or 6 years, prices are still relatively affordable based on what the wages in the local economy are, and that provides support for the real estate market. And what I'm going to show you guys now are some examples of properties that are for sale in these markets right now to show you exactly what I'm talking about, the type of value that you can get. And especially if you're an investor, right? If you're looking for cash flow and yield, these are great markets to target because you can actually find properties where if you pay a certain price and rent them out, you're actually making money from day one after your mortgage and debt service. The same cannot be said for growth markets like Boise, Salt Lake, Austin, and stuff in California. Like, you're not making anything as a landlord in those markets because the price you're paying up front is so high relative to rental rates. But in these markets that we're about to look at, rents are pretty strong compared to prices. So you can buy a property today, rent it out, and get maybe a 10 to 12% rental yield, and maybe that's 6%, 7% after expenses. In a low interest rate environment, that's pretty good. So let's start with Albany. All right, guys, so we're starting with a property here in Albany, and it's a 5-bed, 2-bath, 2,000 square feet. It's on the market for $229,000. And if we could take a look at some of the pictures of this property, we could see that from the outside, definitely needs some new siding, definitely needs a little work. You're gonna have to put some renovation dollars into this thing. But on the inside, it looks pretty good, actually. You can tell it's been renovated on the inside recently. Looks pretty livable. Looks like a nice place. And so this is on the market for $229. And why I like a property like this, especially with 5 bedrooms, is your rental potential. Especially since this is actually close to a couple colleges in Austin, your rental potential is pretty good. So if we scroll down, Zillow will actually give you a rental estimate, which it has at $2,200 a month. So Zillow is saying, based on all the other listings it sees in the area, you might be able to get $2,200 a month for this property. And that's $25,000 a year, right? That's really good. That's actually 11 to 12% rental yield based on the $229,000 purchase price. And then Zillow is also saying that your estimated monthly costs are going to be around $1,261 per month. So you'll potentially will be booking $1,000 a month in profit. Of course, this is, again, Zillow's assumptions, not guaranteed to be this way, but this is what Zillow is saying, and that's pretty good return. And so if you're able to buy a property in 2021 and get a 12% rental yield and say a 6% NOI cap rate, that is strong, right? And that's saying that, all right, maybe you're overpaying at $229. You probably are, right? $229 for that property is probably an overpayment. But at the very least, you're getting good cash flow from day one if you can find a tenant, right? So even if prices do go down by 5 to 10%, it's not the end of the world for you as an owner because you have good cash flow. And it's not the end of the world for the market in general because other landlords in the market are still making good cash flow. In a place like Austin or Boise, if prices start to go down, it's a major problem for landlords because they're actually not making any money from cash flow and they're going to be induced to sell. So that's why, a property like this one we just looked at in Albany shows you the type of value you can get in these bubble survival markets. And let's take another look at one in Buffalo. So take a look at this one in Buffalo, guys, on the market for $79,000. Wow. 4-bed, 1-bath, 1,100 square feet. Funky floor plan to only have 1 bathroom and 4 bedrooms. Probably why it's so cheap. But if we take a look here, we can see this property looks okay from the outside. It actually comes with this, it's a double lot, comes with this grass over here. We move on the inside, we can see it's clearly dated, wood paneling and all that. But, it's clean, it's solid. It's a place that people can definitely live. And for $79,000, this is, seems like a decent deal. Hardwood floors. And so once again, if we go down to Zillow's rental estimate, we see $1,100 a month. So if you were to find a rental for $1,100 a month in this for this property, that's a let's say $12,000 to $13,000 a year in rental revenue. That's a 14% rental yield off the bat. That's crazy. You're not getting that in most other markets. This is the value proposition that these markets, the Albanys, the Buffaloes, the ones that are not sexy, this is the value proposition that they offer in 2021. You're never going to read about these markets in headlines. You're never going to feel excited, let's say, about investing in them. But when you do the math, when you do the pro forma, and you see what you can earn as an investor, it kicks the crap out of these growth markets like Austin and Salt Lake City. It really kicks the crap out of them, right? And you feel much more secure investing in a market like this. But let me tell you, the next downturn is going to be very cash flow centric. So especially if capital gains taxes increase, right, and all of a sudden markets with appreciation that are appreciation driven, if owners in those markets feel like their appreciation is going to be hit with capital gains tax, there's going to be a lot of selling in those markets and a lot of inventory. In markets with high cash flows, there just won't be the same type of pressure to get out of the investment to flood the market with inventory. Okay, let's take a look at one more. Now we're going to look at Omaha. All right, guys, we got this property in Omaha, $170,000, 3-bed, 2-bath, 1,500 square feet. Let's take a look at some pictures. We can see that this thing is pretty nice. You got an okay yard here in the back, some nice trees in the front, a garage, lots of exterior shots here. Let's get to the interior. Pretty nice kitchen, actually. Nice wood island here. Hardwood floors, or maybe those are laminate, actually. Probably laminate. But this is a very livable space, right? Pretty nice. You know, you could see yourself living here. Zillow's rental estimate is $1,300 a month. So, you know, we're getting, let's say, $15,000 a year in rental income from this place. That's about a 9.5% rental yield. Pretty strong, pretty strong. You know, it's these type of properties, right, where you can buy it and off the bat find a tenant and be making 10% rent divided by price. Maybe it's 5% income divided by price. These are the type of properties that are going to do you well in the middle of a downturn. Of course, guys, I'm not saying go out and buy the properties I just showed you. You know, clearly you got to do due diligence. Clearly there's a lot of things you need to consider more than what I just showed you. But I did this to illustrate the point, right? Even in 2021, even in the crazy, bubbly, insane times in the current housing market, there are still cities and neighborhoods in the U.S. that provide value to home buyers and investors. So you can still find, you know, diamonds in the rough, places that yield you a decent return. You just got to look for them. You just got to know how to use data to do that. So I hope you guys enjoyed this video. I know I've done a lot of stuff lately, you know, kind of on the negative side of the housing market. So I wanted to provide something for you that gives you actionable, practical advice using data about where even in 2021 you can still find value. So I hope you guys enjoyed this video. If you liked it, please make sure to hit that like button. I spend a lot of time putting this content together. All I ask in return is just hit that like button. It tells YouTube that it's a good video, gets me some more exposure. Additionally, please comment. I want to hear what your experiences and thoughts are on the real estate market. When you guys comment, it makes me more informed, so please do that. Additionally, if you guys are disappointed that I only post 2 to 3 videos per week, then you're going to want to follow me on Instagram at reventure_consulting. That's at reventure_consulting. I post a new graph chart data table every single day on Instagram explaining real estate and demographics all around the country. I also post stories of me explaining what they mean, and I also will respond to you on Instagram Messenger if you message me on there. So if you want to get more involved and you want to see more data, definitely follow me on Instagram. All right, guys, that's it for today. Just a scheduling announcement. Next Wednesday, we're going to have a market deep dive on Portland, Oregon. So we're going to be dissecting Portland's real estate market using deep data and kind of come to the conclusion whether Portland is in a bubble or not, whether you should buy or sell in Portland right now, as well as the impacts of a lot of the social unrest that are going on over there on what their impacts might be on the real estate market. So you're not going to want to miss that video. Until then, enjoy your Memorial Day weekend, and I'll see you guys next Wednesday.